Hello traders, Gary Wagner here, just before 11 o'clock in Honolulu, 5 o'clock in New York. It is Wednesday, Fed Day, the 14th day of June, 2017, and this is the daily report for gold and silver. We did get some pretty wild gyrations and volatility in the market, as I anticipated, as news hit the wire, so to speak, when Janet Yellen spoke, as well as the press release from the Federal Reserve. Of course, we'll talk about that in detail as we pull up our technical studies and look at the net effect. Gold, which had been trading about $10 higher, began to trade under dramatic pressure. I believe at its low, which was a $12.59, was off roughly $10. So we had a $20 swing on the day. It did close off on the day, off about $5.20 to close at $12.6340, and the high today was $12.84. Silver, however, did track higher on the day, but nonetheless an extremely volatile day. You can see that by this high right here as we look at this daily chart. But silver ended up closing up 11 cents on the day, net change of about 0.7% to close at 16.88, the low 16.79, and the high on the day 17.36. So traders, how do you spell volatility? Well, at least for today, I believe you spell that with FOMC. We definitely saw the kind of market gyrations that I expected, although they even surprised me. I didn't expect to see the kind of market volatility that we saw today. Of course, at the beginning of the day, gold was trading up about $10, but as I said in my opening letter, that was probably in response to the tragic and violent shooting of a congressman over in Virginia. But here is the start of the day. This is the beginning of the 14th. Of course, this being a very, very short-term 30-minute chart, we can see that initially into the market we had this tremendous spike up, and then from there it kind of traded sideways roughly at around 1280, and I believe that this is when the announcement by the Fed came in. That would seem the best. This is at 8 o'clock. This is when they would actually announce it, and then I believe 8:30, this of course being in Hawaiian time, corresponding to 2 and 2:30 Eastern Standard Time. Market actually spiked up initially to about 1284, and then for the next hour and a half tracked dramatically lower, going to these intraday lows at about 1258, just above that, before settling off about $5 on the day at 1263, 1264. Now, traders, as you know, over the last couple of FOMC meetings, we actually were positioned with long gold positions going into the meeting and the conclusion of the meeting. We didn't do that this time because I had a sense that we could see some increased volatility. That was really based on the assumption that they might reveal their asset liquidation program and plan, which in fact is exactly what happened. And so for that reason, we saw this extreme volatility. Now, the question is, where will the market go from now? And have we caused any kind of major chart damage as we look at current pricing? Well, the one thing that we can say on the negative side is when we look at our 38% retracement, and again, this is a daily candle, defined long tail, meaning the placement of the high to the open, which is up here, and close is a huge distance in terms of price range. As I said, we had about a $20 range. And the fact that we closed below the 38% retracement, to me, is pretty bearish on a technical basis. On a bullish basis, or not so much bullish, but chart damage-wise, the fact that we closed above gold's 50-day moving average sheds a little bit of hope into the market. However, we have to see some sort of a technical confirmation, be it by Western technicals or candlestick patterns, which is traditionally what I look for that pivot when it meets other criteria. And since we don't have that, I do believe we could in fact see, at least for the short term, gold continue to track lower. However, this is where we'd want to see a bounce at the 50-day moving average. So the next couple of days are going to give us tremendous amounts of information as to whether or not gold finds support in this area, and we could see a pivot, or if we can expect lower pricing. If the market continues to trade under pressure, the next real area that you would look at on a technical traditional basis has to be a 61% retracement, and that comes in at 1246. So traders, my recommendation is we are going to remain with our neutral stance at least for a couple of days until we see how gold reacts at this new price point, with no active trades in either gold or silver. In other markets that we follow, tremendous volatility in the U.S. dollar index, which closed fractionally unchanged on the day at 96.88, but that is only after the market had traded under dramatic pressure and going to a base price of 96.20 on an intraday basis before recovering during the last couple hours of trading. Dow Industrials closed higher on the day, but well off of their highs, up about 46 points at 21,374. But the Nasdaq Composite, as well as the Standard & Poor's, did close under pressure. 0.4% loss in the Nasdaq, 24 points, closing at 61.95. And then the S&Ps really closing fractionally unchanged at 24.37. With the kind of volatility that we saw today, I'm pulling up a very short-term chart of the U.S. dollar. This chart itself has candlesticks that are 10 minutes in terms of the length of each candle. So we can see that the dollar had slowly been meandering to higher pricing, actually hitting at about above 97, just shy of 97.10. The 14th starts here. And of course, just as the gold market reacted to the tragic incident in Virginia, we saw the opposite happen in the dollar. The dollar spiked lower, actually tracking down to our target, which has been around 96. We hit this intraday low at 96.30 before a pretty substantial recovery, moving back above 97, only to settle lower on the day, but fractionally lower at 96.87. And traders, lastly, I do want to look at a short-term study in the Nasdaq Composite. And the reason that we are looking at short-term studies today is obviously what we are looking for is the kind of reaction we saw as events played out within the marketplace. And so that when we look at the Nasdaq Composite, we can see it was trading absolutely flatlined, trading in a tremendously narrow defined range, that range being a couple of ticks on each side. That was until the Fed announcement came out. Again, policy and the press release comes out at 8 o'clock. That's here in Hawaii. It corresponds to 2 o'clock Eastern Standard Time. From there, we saw a tremendous decline in the Nasdaq and at the same time, a pretty substantial recovery. The Nasdaq still closed off 0.4%, down about 25 points, but certainly well off of the lows today. Traders, over the last couple of days, you know that as we spoke about the upcoming FOMC meeting, which concluded today, it was largely anticipated that we would see an interest rate hike. We saw that, and that, I believe, was already factored into the market. However, a couple of wild cards definitely came out of today's policy meeting. One of those wild cards was the announcement that the Fed plans on one more rate hike this year. And then the second, and I think the most volatile of all of the announcements, was the budget asset liquidation plan that the Fed looks to implement, which they could implement as early as this year. That really was a wild card. That sent gyrations into the market, and the pace is quite aggressive. As I said in our opening letter, it's going to take market participants at least a day or a couple of days to digest this news. But nonetheless, I think we got more than we had bargained for from the Federal Reserve today. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.